All right. Thank you very much for joining us for this workshop about the exit of a startup with a strong focus on the founder. We are very grateful for your participation because it's very sunny outside. You could be enjoying the sun instead of listening to lawyers talk, but the good news for you is that you won't hear much lawyers talking this afternoon. We have a very successful founder with us, Frédéric, that I will present in a while. So we're very happy and thank you very much and welcome to this workshop. So my name is Alex. I'm a lawyer and I'm a partner with the law firm Keller Carrard. And it's a real pleasure to have you here. I would like to thank you, or to thank also the Swiss Startup Days organization committee, because we are here every year and it's getting better and better. So thank you very much to the team here. And I'm here today with my friends and colleagues, Max and Arnaud, who are both also lawyers and also partners at Keller Carrard, one in Geneva, the other in Lausanne. I'm also located in Lausanne. But as I was saying, we're not alone. We're very happy and very fortunate to have with us today Frédéric Descouters, who will be our basically main speaker today, who is, an entrepreneur, a successful founder. He's a board member, he's a chairman, so he's really the one that gives you this very important track record that you need as a startup. So we're very happy to have you with us. Thank you, Frédéric, and he will present himself a little bit later and present his journey as a founder. When I was looking at the other, legal workshop today, because I'm a lawyer, so I'm always curious. One was about, the incentive plan. How do you provide incentive to employees? And this is something that is very sensitive when the exit comes. So we'll talk about that. The other was the funding. How do you fund your company? And this is actually the first question that we will ask to Frédéric. In the beginning, did you want to grow organically, or do you think that it would be necessary to have external funding? So a very important question. The last one was a sort of survival guide, and we will try to finish with that. Also, the pitfalls, the obstacles that you might face as a startup, and we will try to encapsulate that everything today together. Overall, we think that the exit is a path that you should prepare from day one, or maybe day two, but at least something that you will have in your mind during the entire journey, assuming, of course, that the purpose of your company is actually an exit for your startup. So if you allow us, I'm just going to tell you a few words about who we are. So Keller Carrard, it's actually quite now a large law firm. I'm not going to tell you everything that we do, but you can see that we're in all big cities of Switzerland, including Sion, but it's not on the map. So we have a large startup practice, and no surprise in Zurich, in Basel, and in Geneva and Lausanne, thanks to the ETH, the EPFL, and all the universities. So we advise a lot of startups and founders and also the investors. So we're on both sides, but not on the same matter. We try to be careful on that. So as I was explaining, I'm here today with Max. So Max is actually one of the VC partner at the firm in Lausanne. And he will be trying to answer the question from a legal perspective that Frédéric will describe maybe in more general terms. And he's also a founder, actually, because he co-founded SUD25, which is a platform that is dedicated to the early stage startups. So he might face the same issues at some point that you have faced or that you are facing. And Arnaud is, I would say, more on the M&A and the exit side journey. He's a partner in Geneva, and he will be what we call the MC, so the master of ceremony today. So I will then hand over the mic to him, and he will ask the questions and try to guide the discussion today. So how will we organize this workshop? Because it's actually a workshop. So basically, Arnaud will ask questions to Frédéric, and then Max will try to explain from a legal perspective how you turn the answers and the different issues into legal documents. But hopefully, we will hear more Frédéric than Max.
I will keep quiet.
But this remains a workshop. So it remains a workshop, so you are really not free. You are encouraged to ask questions. share your experience, agree, disagree sometimes. I'll leave it to you to discuss with Frédéric if you disagree. But really, that's the purpose. There is no Q&A session in the end, so you can really ask questions whenever you want. This is a workshop and really benefit from the experience of Frédéric and also from Arnaud and Max to a certain extent also. Now, if you allow me, just a few words about Frédéric, because Frédéric is not a businessman by education. He is actually holding a master's degree in bioscience and engineering from the University of Ghent in Belgium. And he's now the chairman of the board of Alithea Genomics that you might have heard of. It's a Biopole and Lausanne-based startup that we're very lucky to advise. But here he's talking about Genome that he founded in 2010, and which was acquired by Agilent Technologies in 2018, so a multi-billion-dollar US company. So that's going to be quite interesting to hear, how a Lausanne-based company or Swiss-based company can be acquired by a big US company. So we look forward to this afternoon together, or at least these 45 minutes together. And I would like now kindly ask you, Frédéric, to elaborate a little bit on your background, on your journey, not too much for the moment on the exit.
Just, it's also very nice. We wanted to visually represent a founder's perspective from a startup founder. So this is it. So you're basically surrounded by lawyers. I just wanted to do this. And literally all the time. It doesn't go away. So we're here today to discuss an exit that happened 6.5 years ago. And I'm still looking for ways to get rid of them. But it's okay. I start to like them at some point. You just give up and you bond with them, right, Max?
I like you too, yes.
Yeah. So I have a background, as was said before, in engineering. In the meantime, I've read all the books, MBA courses, finances, all of it. I try to defeat the system. It doesn't work. I figured that one out. And so Genome itself was not my first startup. I first did another one that I sold for a massive amount of money, 90,000 euros. I was much younger back then. I felt like really rich. It doesn't bring you anywhere. Genome is more confidential, but that was a different order of magnitude. And as they say, I kind of got a taste of it, so I'm now not doing one but two startups because I thought one startup alone is not worth it. So there's Alithea and there's a currently undisclosed startup. So that's a bit my background in the scene. As you might also hear, I kind of enjoy doing this. I'm very entrepreneurial. I have a different face, however, also. I'm different here than I am in the US. Here I'm like Swiss. I hate people saying in public that I'm successful. I don't like it. In the US, I'll tell everyone I'm successful. So it's a big difference between the Swiss Frederick and the US Frederick. So that's, in general terms, my background. We will come back to other aspects of it during the presentation. Back to you.
Thank you very much. That's going to be my final word. I mean, people here, all the founders and the startups, they are here to meet investors. So they want to seek funding. And the first question to initiate the discussion together was whether in the beginning you thought that it could be possible to grow, organically, or whether immediately you started thinking about funding and seeking the right investors.
You have a mic already.
Oh, yes. Then I
can give it to Arnaud.
In case it doesn't work. I think when I focus back on the Genome story, it was more of a traditional story. So we basically bootstrapped the story itself into my personal home, back then still in Ghent, Belgium, where we built some prototypes. It was a pure software product, basically informatics for laboratories. So we made a proof of concept. We went out there, tried to sell it, signed some early access deals with certain labs, and actually bootstrapped from there. When it comes to capital raising, I don't think, there's obviously examples, but I think any startup at some point you need to raise capital. except if you have means or access to capital inside the family, but still you'll have to raise capital. If you lend money from your dad or your mom, I recommend you still have a shareholders agreement because you never know what's going to come of the startup. But so for me, that was not really, let's say, a question whether or not to raise capital. Also, to give you the full background, Genome was founded like 2009. For people that are old enough, there was a 2007 to 2009 financial crisis, Enron scandal, all of that jazz. And so 2009, 2010 was like the out of the swamp kind of revival. Capital became available again. Private equity came back to the market after they had a huge crash in 2007. And so against that backdrop, we started to raise money also.
Thank you very much, Frédéric. Now, Max, what do you think from a legal point of view about the process of capital raising?
Well, we were in a workshop like 2 hours ago, and one of the founders mentioned that it was difficult to align expectations between the investors. And I think this is probably my main takeaway from building your cap table from day one. You need to know where you're heading. You need to have the right investors for the right journey. So I guess also at one point you will need to raise money, but I think that many founders just see cap table as, well, just a list of investors and amount raised, but I think that some amounts cost much more afterwards than the actual amount invested. So you need to understand the investors you have in and align expectations, mainly with timing. Some funds will need to exit within a certain time frame, which is not aligned with the others. On the other side, you would need to raise capital from family and friends who may need liquidity over the money or are not sophisticated investors, so might create many problems, even though holding a very limited portion of your share of their shares of the company. So I think that having an idea of where you're heading and the people you need and aligning expectations in terms of multiples, in terms of time frame, is of utmost importance from day one. And honestly, even though I would be a bit sad to say this, we always have at least a few shareholders that should not be in a cap table in most of the startups we see. And having someone to get out of the capital is not always very easy and can pollute quite importantly your shareholders meeting and next funding and exit in the end. One more point on this. Be clear on the investors you get in, also in terms of how they emphasize exit. You will need to give reps and warranties, and if you don't know how the fund can actually provide them, you might see them as amazing investors, but very poor investors in the exit process. So since we are in a founder's perspective and in the initial stage of the startups, these are the two topics I would completely emphasize: aligning expectations and knowing the people you have in the cap table.
Thank you, Max. I guess you could say a few words about.
I'll also add to that. It's actually what a lot of people forget, and hence my joke about your dad or your mom or your aunt or whoever has money. Unless you're really lucky, you won't exit your startup anytime soon. It'll take you, I think statistically, 8 to 10 years, or 8 to 12 even, before you have a substantial exit. During all of that time, even for your annual shareholder meeting, for everything that comes to corporate governance, that is defined in the Code des Obligations. I don't know how you call it in the Swiss-German part, but you probably also have a word for it. You need to invite those people. You need to keep them in the loop. You need to contact them. You need their signature every single time you do something. Not just a shareholder agreement, every like convertible loan, capital increase, et cetera, and it's then when you, as your company grows and you get more like professional investors, that you would be amazed how big the gap is between your dad and that VC fund from Boston. They might have different expectations, but yet, according to our Swiss law, they will both have to sign. And then if you don't think it through, and that's why I said you need a shareholder agreement regardless of where the money comes from, you might have very difficult discussions, even to the point where you might have the money, but you don't get to the signature because somebody doesn't agree. And so keep that in mind, that those 15 or 20 or 25K at the beginning might sound like, oh, that's really cool, but with the wrong term sheet behind or the wrong shareholders agreement behind, it becomes a burn.
Indeed.
So.
Yeah, thank you, Frederic, for this precision. And your company growing, when did you start thinking about an exit, and how did you represent yourself the exit? Would it be more a sale or an IPO?
Well, I never, I don't sell anything, as you know. IPO in our case was not on the table. If you looked at the LIM CLN company space, there was no precedence of an IPO. And so I don't think that was ever actually on the table at the board level. By which I don't want to say IPO is, there's many examples also in the startup space over the last couple of years where you can IPO. So it's definitely something possible, but not for us. M&A, but that's my personal conviction. I don't think you can chase an M&A. If you have to go out and force yourself to be sold, it's definitely, you're not in a strong position. So my mantra is more build a product that customers buy. If you sell enough of it, there's going to be a company that wants to buy you. Then you can talk. So and from that position of strength, in our case, the M&A option came on the table when our closest competitor was bought by a big US company. And so that actually accelerated our path to M&A, because other companies like the incumbents in the field were reaching out to me basically to check whether or not we were interested. But I cannot disclose it, but it's a top 5 life sciences company. Their CTO, I still have that message, texted me on LinkedIn saying, I happen to be in the area. Do you have time for a coffee on Wednesday? And I'm not inventing this. Afterwards, he flew in and he said, like, oh, we had to land in Geneva because Blécheret in Lausanne was too small for my private jet. So you see, these people also have issues. Yeah, I sympathized with his issues, but and so that was for us the trigger where I had to bring it forward to the board and say, look, there seems to be interest for drinking coffee and for selling the company. So, but it all came from Genome at the time was tagged as the number 1 or number 2 actually lab informatics solution globally. And because the other one got sold, we got the attention. So it really came from that position. We had something that was valuable. And then the company was acquired by Agilent Technologies in the end because of the value. Not because I actually went out and said, we want to sell it. So
you never really prepared for the exit. It came at the right point.
Max knows me. Preparation is not my...
It was very well prepared anyway.
I did prepare for it a little bit in the sense that most companies focus on marketing their products to their customers. I think many startup founders, that's what I advise often also is, don't forget to also market your company. And that's a different thing. Marketing your company means you get out there, you talk so people know you. Anyone that acquires you will not acquire the company for the product. They will acquire the company for the management, the people, and what makes the company. And then, of course, also for the products. But if you forget to market your company, there's little chance, I think, you will be known in the field and there will be interest to acquire you. Mm-hmm, mm-hmm. So compare it with, you see a nice, like soccer ball in Coop, I say like, that's nice, but if you don't know the company behind it, you're not going to be like triggered to actually buy the company that creates the soccer balls. So it needs to come from both ends.
Sorry, you mean company, the team?
Yeah, but as the management, as the C-level of the company, what I often see is they don't get out there. They focus a lot on product development and product sales, but they forget to go to conferences and actually present the company. Not just the product that you create, but also the company.
But the company is at the beginning product, but the team.
But the team also, yeah. Yeah. Exactly, yeah. People need to put a face to who's creating that product. And if you don't make that link available, it's and for many, I think startup people, it's you getting out there. It's the part I just referenced, like a bit. We in Switzerland, it's like a bit bragging. Oh, I'm very good at what I do. We are more like, okay, I invented something, leave me alone, and I'll just sell it. And so try to fight that. Like take the plane, go to San Francisco, and do a little bit what they do. So.
Sorry, did you have an M&A advisor during the process, and at which step did you
They're hijacking. I told them they were going to hijack these slides.
You knew this.
Yeah.
So you're 10 questions ahead, but we'll get there. No, perfect.
No, it's okay. Yeah.
We could go directly to the question. I think it's important to discuss immediately.
It's for the process, you need interested parties that want to buy you. You need a good management team and a few people in the company that get you through due diligence. You need, they're paying me for this, you need good legal advice to get to a good deal deck with the correct reps and warranties. But you also indeed need an M&A banker in between, or an M&A advisor in between. I know there's legal lawyer companies that do both. I'm not a strong believer in that. There's M&A banking companies that specialize just in gathering the term sheets and getting to the best deal. And then your legal actually signs the correct terms for the deal. I think you should. And every industry, every niche in every industry actually has specialized companies. There's not a one-fits-all kind of deal. Like for me, if you're in IT software, go to the US, talk to a few M&A bankers there. You'll probably get the best deal. If it's for big pharma, there's quite some specialized boutique M&A bankers here in Switzerland because we have a rich pharma ecosystem. So try to find a good one that you trust, where you have a good connection, because they will need to like at least have some bid or some competing offer out there. Yeah.
Thank you, Frédéric.
Yeah, if I may
Let's
add
maybe hear Max. No, absolutely.
I think we
wanted
jumped to the questions on M&A advisor, but I think it's important to tackle already because we just discussed it. You need them, honestly, just also to know how to discuss with the people who will actually sell the company in the end. Because even though the board of directors will be initiating the discussions with the potential acquirer, in the end, it's the shareholder selling. And they need to understand that the deal they're having on the table is the right one. And having an M&A advisor who's actually in the actual market where you're evolving, knowing the transaction price, the multiples, whatever you can get, will help a lot to explain to the people who will eventually sell the shares to understand that the right deal is on their table. And I think this is something that sometimes is not fully understood, is that you will need to have everyone on board. Of course, we can help in drafting any agreements, but enforcing a drag-along clause at the exit time is imperfect, to say the least. So if you have everyone agreeing to that, and I think an M&A advisor is a game changer here when they're really in the market. Also, they will help you get, let's say, win the beauty contest. I mean, get you in the shape to actually be the most sellable you could be when someone expresses an interest. So, yeah, M&A advisors in the market you're evolving is absolutely necessary, and I think it's not really an option depending on the deal. Also, managing the people who will sell.
But in your case, when did the M&A advisor came in? Was it a bit before?
No, and it was so after our biggest competitor got acquired by Thermo Scientific, and then after that coffee incident the week after, literally, I brought it to the board. The board actually said, "Okay, investigate." Some people at the board actually advised, "Look out, let's see if you find an M&A advisor." So we reached out to a few of them, then picked one. And then with that advisor, we actually went back to all the companies that in the meantime contacted us. So it was a bit, yeah, from that perspective, it was a bit a dream scenario because people came to us reaching out saying, "Are you interested?" So
that's a good segue for our next question. What gives, in your experience, founders negotiation power in connection with an exit? So in your case, we have the impression you had multiple exit plans because you had multiple interested parties.
Yes, but even though that was the case, I always come back to the basics. Control your own destiny. Like, again, if you have a product that sells, and you can control the sales, even the growth and the profit margin, and you can calculate all of those things. If you always have an exit plan at some point where you go like, okay, we scale down on growth, but we get to positive EBITDA, you control your own destiny. And combine this with a product that the market wants, the only reason to fail then is because of mismanagement of the company. I'm sorry. Then you're just not doing it correctly. And so from that position, you can always then talk from that position of strength with acquirers. I think there's, of course, there's also exits where the story is not that rosy, where you have to sell basically, being it an investor that needs to exit, that pushes you towards the exit, or just cash running out and you just basically do some sort of asset transaction to not lose everything. In that case, I think you just have to take what is offered, what is on the table. But otherwise, as long as you control your destiny, another important one, don't get distracted during the due diligence process, because what they all like to do is, oh, you forecast revenue of 5 for this year, whatever the unit. But the due diligence takes 6 months, and they'll send you also an army of PwC consultants to keep you busy. And then after 3 months, they say like, yes, but you forecasted 5, but you're only at 2. You can never say, yeah, but you kept me busy. So that's another thing. That's, again, this controlling your own destiny. Due diligence is a nightmare. They'll keep you busy for days on end. But you're completely entitled to say, I don't have time for you. I want to execute my business plan. And that seems to be missing from many people. They go like, they focus so much on the PwC guys. I really hope there's nobody from PwC. Okay, McKinsey guys, and women, they're equally worse. And you focus so much on them, but they'll get back to you on you missing out on your business targets. But you're entitled to tell them, I don't have time for you. I'm executing on this really big deal. And the acquirer will even appreciate that, just not the consultant looking at you. And that's always, always, always key. Even at that stage, you can drop that because the trust is gone. You don't get to the 5 and you said 5, so. Or they come back with all sorts of clauses that you don't want to see in the reps and warranties. That's another one. So really be convinced of yourself. Like, you want to buy us, and you don't see this as an end or like something bad happening. It's a good thing. You're selling the company to a bigger company. We're going to do big things. That's, again, very un-Swiss mindset, but that's the mindset. And so you approached this whole discussion from that mindset. Not from, oh, thank you for buying my company. Yeah, screw them.
Thank you, Frédéric. That is very interesting. So there is the situation in which you control your destiny, you have a little bit of negotiation power, and there is the situation in which you control less your destiny and you have less negotiating power. But I think from a legal point of view, there is a lot to say, traps not to fall into when you have negotiation power.
Yeah. First thing, maybe I'm reverting just to the IPO M&A, but just to clarify why we don't put much more emphasis on the IPO. To a certain extent, it's not a real exit for the founders. You will probably get locked up for a while after the listing. You will have to provide afterwards a lot of things, and it's a nightmare, as you said, to sell and due diligence process. IPOing, another story again. So yeah, it's a nightmare for previous regulatory matters and after. So you need to really know your destiny and control it. Where am I heading, and am I in the right track for this? And here, I think that gaining powers from a startup perspective and the legal perspective there is first exactly controlling your destiny, not being stuck in a position where you don't have actual options in front of you. Not saying necessarily that you need to have 10 acquirers potentially, but just saying, well, if this fails, what do I do? Am I clear on that? Because those deals takes long time. IPOing, very long. M&A long. So having options to finance in the meantime or not running out of money before the transaction occurs is something that you really need to focus on and not lose track of because, well, it's the game. So in the other side, they will make sure that you lose sight of this. Second point, maybe when you have what we call dual or triple tracks where, well, I could IPO, but where quite often you could IPO, so you prepare for this, but an M&A transaction just occurs before the listing because, well, we prefer to acquire you than having to acquire the publicly listed shares. So this happens, so those two tracks could be followed. Or you're discussing an M&A with 2 or 3 potential acquirer or an investor. And there, the main trap is, of course, what they will try to obtain from you. It's an exclusivity clause that I would suggest to discuss extensively with your lawyers because sometimes you feel like, well, we're discussing an M&A transaction, so I'm fine for discussing with investors in the meantime. Well, the exclusivity clause actually prevents you from doing so, and this is something that we quite often see.
Yes, on this, Max, that's also where the M&A banker comes in very handy because he can be the bad cop. He can literally say to that acquirer, I'm not giving you exclusivity because if you insist once more, we're going to the next one on the list. Even if there's no next one on the list, by the way. They just go to the next one on the list. And that's the bad cop role that you cannot play as a CEO, nor they can play as my advisors. So that's another reason to have this M&A banker in between. Yeah.
Strongly. And last point, maybe, once again, we discussed that where controlling your cap table from day one. The question to keep powers in negotiating is who's controlling the actual exit and the transaction? Is it the founders again? Is it the investors of the first round, second round? And it could be like, well, a small portion of the shareholders that actually causes trouble within the M&A. So gaining power is also making sure that you can control the actual fate of the M&A. And this is built from day one in strong alignment of interest with investors around the different financing rounds. So I think having people aligned with you on that is very important. And even though you can fully tackle it with legal, you need to understand who's involved in your cap table from day one. So this helps also keeping powers while negotiating an M&A transaction, I would say.
Yeah. No, thank you, Max. That is a good. That is a good point to raise. And now on another topic, we wanted to know what was life for you after the end of the M&A transaction, after the exit. Was it really a liberation? Were you absolutely free? Or were you still fully hands-on with the company?
Are you going to say Liberation Day? I don't know. Very sensitive nowadays. Liberation Day. I didn't
VC guys anymore, liberation.
When it came to Genome, I didn't have any clawback clauses. I didn't sign anything to stay at Agilent Technologies. So I could have walked day one, but again, I didn't sell the company to get rid of it. I sold the company because with Genome we were hitting some boundaries that we could not. Yeah, we were scaling boundaries. Let's summarize it to that. And so Agilent gave us a way to really scale, for example, in China. Like from day one, they said, in reality, from day 500, more or less, after I got through all the procedures inside Agilent, but okay, yet it's a big company. And so I stayed for 5.5 years after the acquisition. Grew the team actually more than doubled the team from the Genome acquisition size to when I left. So it didn't, I didn't feel like bounded by it. It's a whole different discussion on, but then Frederick, why are you not at Agilent anymore? It was a personal decision. I got, like once you reach VP level at a big US firm, apparently you're not supposed to, you have to be way more serious, let's put it like this. And it didn't flow well with what I wanted to do, and I wanted to get back to the startup ecosystem. So that's basically, it was a personal decision. But from the other end, during the acquisition, however, that's maybe something else to highlight is, so you basically sell the company, at least, again, my point of view, because you want to like make the next leap, scale it, grow it. So that's why you sell the company. Secondly, you pay attention to the employees. You want to give them a new family to join almost, like a new setting where they can also develop and grow themselves. And lastly, you sell it for the shareholders. Because if the first two things are correct, then the shareholders should automatically also be happy. And so that's, I think that's also something maybe overlooked sometimes. You don't sell the company to get rid of it and to pay out your shareholders, in my opinion. So you really have to, as a startup CEO, you need to keep telling this to your board, that at the end of the day, you have this fiduciary responsibility basically to pay them, but there's more than just paying your shareholders. There's also the employees and the company itself. So, and that was again in my case, but I stayed for 5.5 years to really grow the company further. So
we will talk about the employees in the context of an exit. Thank you. Max, what can you tell us about deal structure, which impacts whether or not a founder is free after the exit?
Yeah, I wish all founders could actually decide the fate entirely of their situation after a transaction, but honestly, from lawyer perspective, quite often you will see that you are forced to stay for a while. First, to get actually paid. Sometimes you have a big portion of the purchase price, which is actually an earn-out. So you actually sell for a certain price, and then you undertake to reach certain milestones that will trigger another tranche of payment for the shares, which usually involves you staying. So transaction itself is not actually a freedom afterwards for a while, and sometimes it could be quite long. You will also quite often see non-compete, non-solicitation clause, so you're not totally free to actually rebuild the same business the next day, and the acquirer will actually make sure of this because you are of utmost importance within the company. So of course they don't want you to actually be able to compete or solicit any employees that you were working with. And a third point that I think we need to emphasize within the freedom of the investors, of the founders after transactions, is something that is not really looked at sometimes by the founders, is the reps and warranties that you will offer to your acquirer. So basically when you sell, you will confirm that you have no ongoing litigations or that they are tackled, you have no problem with your IP or tax have been paid or whatever. A huge list, depending on the transaction, the huge list could be 100 pages long. Of course, you're not totally free, and you still have in mind that, well, maybe a portion of my actual selling price could be paid back because of a breach of a warranty or of a misrepresentation of what I've confirmed. So I think that preparing for all of that from day one and knowing that those will be the topics discussed should theoretically lead founders to think about those topics from day one and keep good governance from day one also to avoid these kinds of heavy problems that could occur afterwards. So freedom, yeah, it's part of the negotiations. Employee will revert. But yeah, knowing that the transaction is not, I've sold and then I'm free, this is usually not the case.
Yeah. But another one to add on that, although in my case I was free, it is true, however, and it's something you have to, as C-level from a startup, you should also negotiate. Because the higher the position is you have in the acquiring company, because after the acquisition, you are part of that company, which means that if you have a high position, you can actually influence slightly any triggering of reps and warranties, because you become part of them, you're not the other one anymore. And so they also know, although they didn't let me sign anything, they also know if I would have left, then you leave the reps and warranties open for another manager to abuse. So it's a double-edged sword, right? But yeah, so it's... And it's another one is to put a term on the reps and warranties, Max?
Yeah.
As you've done correctly with us. Because this was not 5.5 years for people thinking it was 5.5 years. It was much shorter. But indeed, it's a power that you gain by actually joining that company that most people don't see if it's their first acquisition. Again, assuming there's acquisitions where even the CEO doesn't really get a position inside the acquired company to make any influence. So but it should be part of the whole negotiation process. Like, okay, you buy me, but what do I do on your end? Like, if you go from CEO to being a line manager, you have to ask yourself the question, like, do they really also value the business? I mean, what are they going to do with it? So.
Yeah, and aligning the earn-out questions is very tough, and especially if you're doing very well, then it's also a ground for them trying to trigger reps and warranties because they want to limit the amount paid in the end. So yeah, aligning all of this and be very clear on your position afterwards is also, of course, very important to manage in the deal mechanics. And maybe last point, you're not always getting cash out of a transaction. It could be also shares of the entity that's acquiring you. So yeah, thinking all of these implications, what I'm actually getting, and am I free with that, or is there a portion that is subject to risk, is important to know from day one, also from legal perspective.
Thank you. Maybe let's talk, because time is advancing.
Oh, yeah.
Let's talk about the role of, or the position of employees in connection with the exit. And can you tell us a little bit how you manage your employees, and in particular their stock option plans?
Stock option plans in Switzerland are interesting. Because I think we need way better regulation in Switzerland when it comes to stock option plans. At the end of the day, correct me if I'm wrong, but they will be seen as a salary convertible for the employees. So if they have 10 Swiss francs worth of stock option, at the moment of conversion, this will result in 10 Swiss francs added to their payslip of that month even. So it's that's a bit annoying, because if it's slightly more than 10 francs, it can be a nice bill from the
Tax
tax
administration.
authorities. I was now thinking about how that word I actually do know in Zurich for some reason. So yeah, but that's besides that, it's an opportunity to actually explain to the employees, the early ones, that during years or even during a decade, in my case, didn't even know what stock options meant. And it resulted to them in a sizable thing that allowed them to buy a property. So it was to give you an idea. So you end up with an awful lot of very happy employees. But it's a tricky thing to manage, because you also have the question then on you have to immediately disclose it to the tax authorities. They want to have the deal size just to make sure they don't miss out on the taxes, I assume. But it's both. It's an annoying thing, I would say, ESOPs, and a happy thing. It's a bit of a mixed bag, which is unfortunate, because it should be like happy news. Like in the US, it would be happy news. Nobody would ask questions. And here we are always like, burdened a little bit with the legal and the tax authority questions surrounding it. Yeah. So.
I think a lot of cantons are making progress in this respect, and you can obtain a ruling, and you describe how it will be structured.
What's
taxed.
the average time for a ruling? Are we less or more than 2 years?
No, 1 or 2 months, 1 month, something like that.
Depends.
It depends a little bit. We have 26 cantons. I guess some tax authorities in certain cantons are not very familiar with ESOPs, but in other cantons they are very familiar, and you can have more interesting, at least first, visibility, and second, a better structure from a tax perspective for the employees. And Max, when can you tell us about less from a tax perspective, but more from a commercial law, civil law perspective, the structure of the ESOP in connection with the exit?
Yeah, maybe 2 things that is important to understand, because usually you will adopt an ESOP within the company a long time before the actual M&A or any exit transactions. And here you will consider saying, well, there is a vesting period for the options for the employees that will usually fully accelerate in case of transaction, which seems amazing for employees, meaning that you have like a quarter of your shares theoretically vested as an employee, but because of the transaction occurs, the change of control, then 100% is accelerated. If you don't think about the fact that maybe the acquirer will want some key people to stay, you face the problem of this full acceleration, leading with the employee saying, well, now I'm sometimes rich, so why should I bother staying after it? Because I'm not the main founder, so I could theoretically leave. So what you would possibly do, and what we try to have usually, is what we call a double trigger acceleration clause within stock option plans, where for certain key people, the transaction is an acceleration case, but if requested, they have to stay for a while after the transaction and keep working because of the transition necessary. And you want to keep some employees involved. And well, we could hope that they want to stay, but sometimes they will have to be forced to stay for a while because of their...
one in the US. You often also see a bit the same. It's not linked to the ESOPs. If they stay for, say, 2 years or 3 years, then they get an additional payout,
Indeed, yeah.
which is not linked to the transaction price and does not impact the shareholder. So, in especially Silicon Valley is not bad for these kind of constructs.
Yeah, you need to discuss who's bearing the risk of employees leaving. So is it me with this kind of clauses in my ESOP, or is it the acquirer that should actually incentivize the employee enough to remain within the company? That's an important topic, I think. And one more thing, because it's funny, knowing what are the implications for employees. For instance, if you have some people in France, just for you to know, if you sell your company, thanks to Benoît Hamon, you have to offer the company for purchase to your employees. So for a 200 million deal, you need to start to make an offer to your employees to acquire the company before being able to actually sell it to any third party. So yeah, knowing how you will tackle your employees in this kind of situation where you need to offer the company to employees is important, and also the jurisdiction because of tax is important. It's where the employees are living actually. And so yeah, not only Swiss tax authorities, but the entire world, depending on where you have subsidiaries, is an important topic to address. And it's difficult to manage employees within the transaction time frame, because sometimes when you're agreeing on the price and everything, then you need within 10 days between the signing of the agreement and the closing to gather many signatures. So being quite clear on how you tackle employees is important.
So guess who from us is from Paris?
That's me. Need to be clear. Thanks.
Maybe one last question with a quick answer, if possible. Frédéric, to close the session. If you had to do it all again, would you do something differently?
Again?
Not many.
Please, no.
On this particular transaction, I would have been, although we got a lot, we got payouts for the employees, we got really good payout packages for the employees. I would even go further in my demands on what the position meant within Agilent. So I was already pretty high up. So I was 2 promotions from becoming CEO. I would never. I mean, me at Wall Street, can you imagine? It would be a bad idea. But once you get during the transaction window, there's lots of things that you can do, like locking in post-transaction investments in the business, because that's a different budget. But once the transaction is done, you roll into their annual budget cycles. And although they make you promises of what you can do with the business post-transaction, if it's not locked into the transaction deck, you just become one of the senior partners managers that have to ask for the money. As one example, so I would even be more pushing on the post-transaction conditions on what it means for the company they acquired. Mm-hmm. Because at some point during the negotiation, once they stepped in and said, we're going to buy this, there's a window of opportunity where you can make demands. That sound logical for them also, because they're acquiring it to grow it. So, and that's actually something also that maybe from a legal perspective you should emphasize more. Mm-hmm. Like, be bold at that, because most people then, like, it's almost like the deal signing is just in front of you and they just want to get to the signature. But they're not going to run away anymore at that point. So take 1 or 2 days more to really flesh out those details. Mm-hmm. Like, say, okay, and you have to wait anyway for the French guy that is blissfully unaware of anything happening. So really do this, like, step back a bit and go like, okay, did I think about everything? Because then once you become part of a big company, you're not the startup CEO anymore. It's not like you decide we're going to spend 50,000 on this, that is going to happen. No, you'll have a financial controller and all that jazz and processes and I don't know what, SAP systems. So it's something you have to think about, actually.
Yeah.
So that would be the only thing. Otherwise, no. And the second, once you've been CEO and you did the due diligence and so on, your next, just become chairman. Then you have a CEO who does all of that. Don't tell Ricardo, please.
Thank you very much, Frédéric. I think we could continue, of course, listening to you and hearing your experience, but we have to close the session. Thank you very much, Max, for all the specific and precise legal points you made. That is very helpful, I hope, for the audience. Thank you very much for being here and for listening.
Bravo, Frédéric. Thanks.